Credit. What is it and why should you care? Let's break it down. Credit. It's a word we hear a lot, but what does it actually mean? And why is it so important in our daily lives? Simply put, credit is the ability to borrow money or access goods and services now and pay for them later. It's a powerful financial tool. It's like a financial trust fall. Lenders trust that you will pay back what you owe, with interest of course. This trust is based on your credit history. Think of it this way. You want to buy a car, but you don't have all the cash right now. That's where credit comes in. It allows you to make large purchases without having to wait. You can take out a loan and pay it back over time. This gives you the flexibility to pay in manageable installments. Or maybe you need a new laptop for school, but your bank account is looking a little sad. This is where a credit card can be useful. A credit card can help you make that purchase now and spread the cost over several months. This can be especially helpful for students and young professionals. But here's the thing about credit. It's not free money. It's essential to remember this to avoid financial trouble. It comes with a price, interest. This is extra money you pay for the privilege of borrowing money. Interest is what you pay for borrowing money, and it can add up quickly if you're not careful. It's easy to fall into a debt spiral. That's why it's so important to understand how credit works and how to use it responsibly. Financial education is key. Your credit worthiness, or the likelihood that you will repay borrowed money, is determined by your credit history, which is tracked by credit bureaus. Maintain a good track record. A good credit history shows lenders that you are a safe bet, while a bad credit history can make it difficult to get approved for loans, rent an apartment, or even get a job. So, take care of your credit and use it wisely. Revolving credit versus installment credit, know the difference. Not all credit is created equal. Each type has its own characteristics and specific uses. There are two main types of credit, revolving credit and installment credit. Both are essential for different financial needs. Knowing the difference is key to making smart borrowing decisions. This can help you avoid financial trouble down the road. Revolving credit is like a revolving door. You can borrow money up to a certain limit, pay it back, and borrow again. It's flexible and convenient. Credit cards are the most common example of revolving credit. They are widely accepted and easy to use. You can use them for everyday purchases, online shopping, and many other transactions. You can even use them to access cash advances. However, watch out for high interest rates. Installment credit, on the other hand, is a one-time deal. It's more structured and predictable. You borrow a fixed amount of money and agree to repay it in equal installments over a set period of time. This makes financial planning easier. Think of car loans, student loans, and mortgages. These are all examples of installment credit. They are essential for large purchases and education. Each type of credit serves a different purpose and comes with its own set of terms and conditions. It's important to read and understand these terms before you commit. Revolving credit can be a convenient way to manage your finances, but it's important to avoid racking up high balances that can be difficult to pay off. Discipline is key. Installment credit can help you achieve major financial goals, but it's crucial to make sure you can comfortably afford the monthly payments before you commit. Plan ahead and consult with a financial advisor if needed. How credit works. It all comes down to your score. Your credit score is essential for your financial health. Now that you know the different types of credit, let's talk about how it all works. It's important to understand how it's calculated and what factors influence your score. When you apply for credit, lenders check your credit report from one or more credit bureaus. These bureaus collect and maintain information about your credit history. Your credit report is like a financial report card. It contains detailed information about your credit history, including your payment history, outstanding debts, and any negative marks like late payments or collections. Every detail counts. Based on this information, a credit scoring model calculates your credit score, a 3-digit number that represents your credit worthiness. This number is crucial for lenders. The higher your score, the better. A high score indicates that you are a low-risk borrower. Credit scores typically range from 300 to 850, and lenders use them to assess your risk as a borrower. Understanding where you stand on this scale is vital. A good credit score can open doors to lower interest rates, better loan terms, and even higher credit limits. This can save you a lot of money in the long run. On the other hand, a bad credit score can make it difficult to access credit when you need it most. It can result in higher interest rates and less favorable terms. Your credit score is a dynamic number that changes over time based on your financial behavior. Every action you take can impact your score. By managing your credit responsibly, you can build a positive credit history and improve your score, paving the way for a brighter financial future. Remember, every decision counts.